Okay, the bond yield is basically the single discount rate that, when applied to all cash flows, gives the bond price equals to its market value. In other words, if we think about an example that we discussed before, remember that we had a bond which has coupon payments of every 6 months with $3. And you can see that we are discounting these coupon payments. So this is the first coupon payment. And the important thing is all of these cash payments, all this cash flow is discounted with the same rate Y. And at the end of this 2 years, which our bond has the maturity 2 years in this case, in this example, we have the face value plus the coupon payment, and we discount this 2 years back to time 0. So mathematically speaking, we set this present value equal to the market price of the bond, because as you know, bonds are traded in the market day to day, and there's a price determined in the market. So by observing the market price, we can solve the discount rate for this bond. And typically, if you look at some data, especially the treasury bonds, which is quite important to obtain the yield curve from these treasury bonds, we can see the yields are obtained for different maturity bonds. Okay, so you can see this is as of September 4, 2018. The yield of the 1-month maturity treasury bond is 2%. This is for the US market, by the way. And you can see that as we have longer maturities, the yields are higher. And this is the case also for different trading days that you can see the data. And I got this data from the US Treasury website. You can check it out. So typically, in the most common case is that as we have longer time to maturity for the bond, the yield is often higher than a short maturity bond. So that means the yield curve, which is basically the locus of these points that we combined, the different yields that we obtained for different maturity bonds. If we combine them in a curve, what we get is a yield curve. And typically, the yield curve is upward sloping. Okay, as I showed you from this data, as the time to maturity goes longer, we have often higher yield. However, in some conditions, basically, if the market expects somehow the interest rates to go down at a future date, then you might observe a humped yield curve, which might have a downward sloping part. So this is the less common case, but it might happen in the markets. As I said, depending on the expectation of the market players in the bond market. And in some cases, this can also be considered as a sign for a coming recession or a slowdown in the economy.